Hello all. So today we are going to start our new topic, which is bookkeeping and accountancy. As per new IBBI syllabus, it carries 3 marks. So before I'll tell you about current session, I would like to highlight that 1 mark theory question is must out of break-even analysis out of this chapter, which we will cover toward last part of the session. This is the full IBBI syllabus. Though this entire syllabus is very lengthy, it may take 50 hours or 100 hours to cover entire bookkeeping and accountancy, but from examination perspective we need to have basic elementary knowledge of these topics as a valuer. So we'll try to touch upon basic key points, and we'll try to understand in a very simple and easy language how to remember these points in exam, and how to score at least 2 marks out of 3 these 3 questions which may come out of bookkeeping and accountancy. It is highly expected that 2 marks theory or 1 mark numerical plus 1 mark theory, or maybe 2 marks of numerical may come out of these last 4 parts, which starts from trading account, P&L, income expenditure, analysis of financial statements, costing, cost, elements of cost, fixed expenses, variable expenses, break-even analysis. So let us first discuss about various accounting concepts. There are multiple types of various accounting concepts. For example, business entity concept. It states that business entity and ownership are two separate independent entities. Also, business and personal transactions are separately entered in the books. Money measurement concept. All business transactions must be measured in terms of money, that is currency of a country. Third accounting concept is going concern concept. It states that business entity continues to carry on its own business activities for an indefinite period of time. Business entity never dies. Accounting period concept. Financial results of transactions are required to be ascertained for a specified period, which are also called accounting period, and it is normally financial year or calendar year. For example, normally in India we follow financial year. However, in case of American countries, normally companies follow calendar year. Financial year starts from April to March normally, and calendar year starts from January to December. Then dual aspect concept. This is fifth accounting concept. So it states that each transaction in balance sheet has effect on two places. Thus, asset is equal to liabilities plus capital. Please remember this formula. In any balance sheet, total assets are always equal to total liabilities plus capital. It's a little bit confusing, and people do not remember this formula, and 1 mark simple numerical question may come out of it. So assets of business are always equal to claims of owner and outsiders. So these assets are always equal to claims of owner and outsiders. So these are the claim of owners, and these are claims of outsiders. Owner's claim is nothing but owner's equity, which is also called capital, and outsider claims are nothing but liabilities. They are also called creditor's equity. Sixth accounting concept is realization concept, and it is also called revenue recognition concept. The concept states that the revenue should be booked into accounting books only when it is realized. Here realization means creation of legal right to receive money. So revenue is said to be realized when cash is received, or right to receive cash has been accrued on sale of goods or services, or both. Both of above scenarios occur. So that means receiving order is not a realization. Please remember, if I receive an order, that is not a realization, and selling good is realization. Next accounting concept is accrual concept. So it states that revenues and expenses are recognized when they are earned or incurred, not when they are received or paid in cash. So revenue is recognized when they are earned and not when they are received. And expenses are recognized when they are incurred and not they are in paid. Both transactions are to be recorded in the accounting period to which they relate. So revenue to be recognized when it is realizable or realized. Please note this point, that revenue are always been recognized when they are realizable or realized, and expenses are to be recognized when they become due or payable, and receipts or payment of cash is immediately effected. Last concept is matching concept. Once revenue is realized, the concerned expenses incurred to generate the revenue in same accounting period should be reported. So if I have sold say one pen of 10 rupees, so if I am reporting that 10 rupees into financial year FY21, so purchase of that item should also be recorded in the same year. I cannot show that purchase in financial year 2022. Next topic is accounting standards. So though it's a huge list of accounting standards, but from examination perspective, let us keep remember these points. These are the standards of accounting recommended by ICAI, Institute of Chartered Accountant of India. There are 32 accounting standards put together. So please remember this point. There are 32 accounting standards. Accounting assumptions. So these are the 5 accounting assumptions. Please remember from examination perspective. Economic entity, separate entity. Going concern, accrual, consistency, money measurement or money unit. Accounting principles, principles of consistency. What does it say? It talks about financial statements are prepared year after year. So as per this principle, financial statements are prepared year after year. Then next principle is, accounting principle is principle of prudence or consideration. State of affair should be reported on as is basis. Prudence implies that profit should not be overstated, but all anticipated losses should be recognized. So we should not overstate the profits. However, any anticipated loss should be immediately recognized. We should not defer or delay any expected loss. Principle of materiality or principle of disclosure. Materiality means relative importance. So all material information should get reported in the books of accounts. Accounting policies. So these are the specific accounting principles adopted by an entity to prepare its financial statements. Entities adopt the accounting policies. So which accounting policy? They adopt accounting policy to maintain quality of financial statement. Purpose of following this accounting policy is to maintain quality of financial statement, to ensure reliability, to maintain consistency of the financial statement, to bring about comparability of financial statement, and to ensure full, fair and adequate disclosure. So examiner may ask why entities follow accounting policies. So these 5 or 2 or 3 or any of these 5 point may come in the question, and answer would be all of the above. Then these are the few examples of various accounting policies, like method of depreciation. It could be straight line method, WDV method, valuation of inventory, FIFO, LIFO, then valuation of investment book value, mark to market value method, valuation of fixed asset book value or mark to market value, recognition of income, recognition of expenditure. Bookkeeping. It is the systematic recording of the daily transactions of the business entity in a particular set of books. It is required to have permanent record of each business transaction to check profit or loss generated by an entity during a particular period, and to know financial position, that is value of asset and liabilities of an entity on a particular date, normally on 31st March of the financial year or 31st December of the calendar year, to show financial impact of each transaction on the entity. So companies do maintain books of account or do bookkeeping for these four following purposes. So these are the classification. Is a table which explains in a very crisp manner, help you understand the classification of accounts. So they are broadly speaking two types of accounts: personal, impersonal. Please remember these two. Then out of impersonal, there could be further two types of accounts: real, nominal. In real, there could be two types of account: tangible, for example, cash, bank balance, P&L, plant and machinery, furniture and fixture, stock, etc. And intangible could be patent, goodwill, copyright, etc. And then under impersonal, second category of accounts is nominal accounts, which is could be of two types: income and expenditure. Income could be investment income, dividend income, interest income on deposit, etc. Expenditure could be rental income, wages, salary. Expenditure could be rent paid, wages, salary, stationery, etc. And second set of account is personal account, in which natural could be. So these are maintained in the name of individuals. Then second is artificial, in the name of artificial accounts, in the name of firms, banks, insurance companies, statutory bodies, etc. And third one is representative accounts. It could be for the purpose of capital drawings, etc. So please remember these table, and 1 mark theory question may come out of this topic, this table only. So these are the three golden rules of accounting. Please remember these three golden rules. As such, there is no logic. You have to simply remember these three principles, and 1 mark theory question may come. And this is the foundation of entire accounting. So personal account: debit the receiver, credit the giver. In case of real account, debit what comes in, credit what goes out. And in case of nominal account, debit all expenses or losses and credit all income and gain. Please remember, these two slides, this slide and previous slide. Please have a printout of this slide or screenshot of this slide, and try to remember. So these are the books of account process. How do we make books of account? So step 1 is making journals, step 2 is ledger, then we make trial balance, and the final step is final accounts like P&L, balance sheet, cash flow statements. So step 1, journal. This is just recording of transactions in order of occurrence, that is in chronological order as soon as the transaction originates. So the journals are not balanced. Please remember this line. Sometimes this 1 mark theory question may come out of this only one line also. Then under step 2, we make ledger. Journal is a book of primary entry. However, ledgers are books of final entries. So whatever entries we had entered into journal, same entries will be re-entered into ledger, in the form of ledger. The entries reported in journal are regrouped and reported into separate ledgers according to their nature. Following are the main type of ledgers basically. So what happens, all entries are simply put into the journal first without any order or anything else, and then after that these entries are segregated as per their reclubbed as per their nature. So multiple ledgers are being made from single journal, one journal, multiple ledgers. Then these are the various type of ledger. So all cash entries will go into cash book, all credit purchase will go into purchase book, all purchase returns entries will be entered into purchase return book, and all credit sales will go into sales book, all sales return will be re-entered into sales return book, all bills accepted will be entered into bills payable, all bills drawn will be re-entered into bills receivable, and all entries that do not fit in any of the above proper above. So the remaining entries are being regrouped into journal proper. So this is very confusing term. An examiner normally asks that which one of the following is a ledger. So this journal proper appears to be a journal, right? But it is not a journal. It is a ledger. So please remember, 1 mark theory question came into my exam also out of this one line. Journal proper. Cash book. Please note that all cash transactions are straightforward reported to the cash books. So broadly, cash books can be of two types. So irrespective of the nature of the cash transactions, all transactions are directly entered into the cash books. So can be of main cash book or petty cash book. So this is the format. These are the formats for main cash book. Simple cash book records only cash receipt and cash payment. Then double column cash book, it records cash transactions plus transactions related to bank. And triple column cash book, this format or this type of cash books allow entry of cash transactions, banking transactions, and cash discount also. So here only cash transaction, then cash plus banking transaction, and third type of cash books allow entry of cash transaction, banking transaction, and cash discount transactions. Third step is trial balance. So it is a double entry statement of accounts wherein total of all debit entries must be equal to total of all credit entries. So that means all debits must be equal to all credits. So this is a trial balance. And then fourth step is final accounts, into which trading account, P&L account, and balance sheet. So trading account tells about viability of the business by determining gross profit. So trading account tells us about the gross profit. And gross profit is nothing but equal to sales price of the goods sold and cost of goods sold. And then from trading account we arrive P&L. This P&L account tells about how efficiently the business is running by determining net profit. So please remember that trading account tells about viability of business, P&L tells about efficiency of the business, trading account tells about gross profit, P&L account tells about net profit. And third one is balance sheet. It tells about financial position on a particular date. So what does it mean? Trading account tells about viability of business, P&L tells about efficiency of the business, balance sheet tells about financial position of the business as on a particular date. It is on particular date. It is for entire period, accounting period. It is also for entire accounting period. Could be 6 months, 3 months, or 1 year. But it is for a particular date. Please remember this point also. Next terminology, solvency margin. Available solvency margin is the excess amount of assets over liability. So this is a simple formula for solvency ratio, which is available solvency margin divided by required solvency margin. So available solvency margin is nothing but equal to excess of assets over liability, assets minus liabilities. So we had seen that assets are equal to liabilities plus capital. So assets are normally more than the liabilities in case of healthy organization. So ideal solvency ratio margin, solvency margin is 1.5. Please note this formula as well as this ideal solvency margin from examination perspective. Now let us discuss about capital transactions versus revenue transactions. So capital transactions, these are transactions benefit of which is extended beyond one accounting period. These can be of two types. Number one, capital receipt. Number two, capital expenditure. So capital receipts give rise to liability or capital in balance sheet, left side of the balance sheet, and may arise due to disposal of an asset. If we sell an asset, then liability or or some capital will increase. Capital expenditure gives rise to an asset, usually enhancing earning capacity. So capital expenditure is in case company purchases a new asset, normally it increases the earning capacity, then it is called an asset. It is called capital expenditure. Revenue transactions. These are the transactions benefit of which is exhausted within one accounting period. So in case of capital, benefit was exhausted, benefit was expected beyond 1 year accounting year. However, in case of revenue transactions, benefit is expected within 1 year, one accounting period. So again, these are of two types: revenue receipt and revenue expenditure. So revenue receipt gives rise to income or gain in P&L. Revenue expenditure gives rise to an expense. So revenue transaction normally affect the P&L, and capital transaction normally affect the balance sheet, broadly speaking. So this is the last topic today's session, break-even analysis. Very important topic, and 1 mark theory is must. At least 1 mark is must out of it. So cost accounting. It is the process of recording and accounting for all elements of cost. Cost can be of two types as under: fixed cost, variable cost. Variable cost is also called product cost. So fixed cost is they remain fixed. For example, rent, salaries, interest, taxes, etc. And variable cost, they vary in direct proportion to volume of production. For example, raw material, labor, wages, electricity. So fixed cost, if I have installed a factory, so even if I do not produce even a single unit, rent I have to pay, interest on loan, taxes or salaries to the employees who are sitting idle in the factory, I have to pay. So these are the fixed cost. And cost of raw material, electricity. So if I start doing production, only then I have to purchase raw material or labor, wages, and electricity will consume. So that is why these are called variable cost. Sometimes examiner may ask a question that whether this type of cost is fixed or variable. So please remember. Break-even. Break-even is the quantity of goods at which the firm is neither making profit nor incurring loss. Please remember this definition of break-even. Thus, at break-even point, total revenue is equal to total cost, and it also means that total money coming in is equal to total money going out. Contribution. This is also an important point from exam perspective. Many times examiner may ask us to calculate contribution of a single unit, and it is also important for calculation of break-even point or break-even quantity, break-even analysis. When a good is sold, it recovers an amount above its variable cost. The excess revenue is called contribution. So if for producing a good, say I am I need to incur 5 rupees of fixed cost and 3 rupees of say variable cost, and total cost of producing the good is 8 rupees. So if I am able to sell that 10 rupees, so 10 rupees minus variable cost, which is 3 rupees, is called contribution. 7 rupees is contribution. So contribution is nothing but total selling price of the unit minus variable cost of the unit. Please remember this formula, very, very, very important. So break-even point quantity, this contribution made by each unit compensates the fixed cost. So whatever extra money the factory or company is getting by selling each unit over and above its variable cost, that is called contribution, and this contribution covers up the fixed cost of the unit. So the point where sum of these contribution just fully recovers the fixed cost is called break-even point quantity. So the formula for break-even point quantity is equal to fixed cost divided by contribution. So it is also equal to fixed cost divided by contribution is nothing but equal to selling price minus variable cost per unit. Let us understand this concept of break-even analysis and break-even point with the help of an example. So let us say fixed cost is 10,000 rupees and variable cost is rupees 2 and selling price is rupees 7. So this is the solution. Contribution is equal to nothing but selling price minus variable cost. So selling price given in the question is 7 rupees, variable cost given in the question is 2 rupees. So contribution per unit is 5 rupees. Here in this question, break-even units is nothing but equal to fixed cost divided by contribution. Fixed cost has been given as equal to 10,000 rupees and contribution has been given equal to rupee, we have calculated here, which is 5 rupees. So total number of units or break-even unit is nothing but 10,000 divided by 5 is equal to 2,000 units, right? And break-even revenue, So break-even units multiplied by selling price. So break-even units we have calculated here 2000 units, and selling price has already been given in the question, that is 7 rupees. So break-even revenue is 14,000 rupees is the break-even revenue. So let us try to solve the previous problem with the help of a table, which is also called break-even table. Sometimes this table may also come in the exam directly, and 1 mark question may ask examiner. So say in the previous example, the company produces 0 units, for example. In that case, fixed cost given in the question is 10,000 will remain same. Since variable cost is 2 rupees per unit, since there is no production, so variable cost 2 multiplied by 0 is equal to 0. That means total cost will be equal to fixed cost plus variable cost, this plus this is equal to 10,000. Since variable cost is 0, so fixed cost is 10,000, total cost is also equal to 10,000. So since there is no production, so the factory will not produce any, will not be able to sell anything. So that means the total revenue, total receipts to the company will be 0. So that means the factory will register or book a net loss of 10,000 rupees under this scenario number 1. In case the factory starts producing 1,000 units, in that case fixed cost will remain same. Variable cost will be equal to 2 rupees multiplied by 1000, that is equal to 2000 rupees, and total cost will be equal to 10,000 plus 2000 is equal to 12,000 rupees. Right. So since 1000 units have been produced and the company is able to sell each unit at the rate of 7 rupees, that means total receipt or total revenue to the company will be equal to 7,000 rupees. So 12,000 minus 7,000, total cost minus total receipt is equal to 5,000, which is the loss. That is why minus sign has been put. So cost is higher than the revenue. That is why company will book a loss of 5,000 rupees here. Third scenario, for example, if the factory start producing 2,000 units, in that case fixed cost will remain same, 10,000 rupees given in the question, and variable cost will be calculated as equal to rupees 2 multiplied by 2,000 units is equal to 4,000. That means total cost will be equal to nothing but fixed cost plus variable cost. 10,000 plus 4,000 is equal to 14,000 rupees. So here the company will be able to sell these 2,000 units at the rate of 7 rupees per unit. That means total receipt to the company will be equal to 14,000. So since here total cost to the company, total receipt to the company are equal, so that means the company will not register any loss or profit at this point, and this point is called break-even point. So at this break-even point, you know, the quantity required to produce to achieve the break-even point is called break-even quantity, and it is 2,000 units in this case. This is second method of calculating the break-even quantity, and this is the break-even revenue. Break-even revenue 14,000 rupees. So these are the two answers to the question which were asked in the previous question. So if we go forward with 3,000 unit, then 10,000 will remain fixed cost, 6,000 will be the variable cost, and total cost will be equal to fixed cost plus variable cost equal to 16,000 rupees. But these 3,000 units company will be able to sell at the rate of 7 rupees per unit. That means 21,000 will be the total revenue, total receipt. So this will lead to 21 total net profit of 5,000, which is nothing but 21,000 minus 16,000 rupees of fixed cost. Total receipt minus total cost is equal to 5,000 rupees of profit. So if the factory will start producing 4,000 units, in that case fixed cost will remain same, 10,000. Variable cost will increase, 4,000 units multiplied by 2 rupees per unit, 8,000 rupees. Total cost will be 18,000, but these 4,000 units will be able to sell at the cost of 28,000 rupees. So total revenue to the company will be equal to 28,000. 28,000 total revenue minus total cost of 18,000 is equal to 10,000 rupees of net profit to the company. And fifth scenario, subsequently, if factory start producing more units to 5,000 units, say, in that case fixed cost will be 10,000, variable cost will be 10,000, total cost will be 20,000 rupees, and total revenue will be 35,000 rupees. 5,000 multiplied by 7, right? So 35,000 minus 27,000 is equal to 15,000 rupees of net profit. So with the help of this table, we can calculate break-even point, break even quantity, break even revenue, or any other information, say if examiner is asking. So we can also calculate data in this type of table also. So this is third method of calculating, break even point or break even quantity or break even revenue. Sometimes examiner, instead of giving data, sometimes give table also, or sometimes examiner may also give some graph in the form of this. So we should be able to understand that how to calculate break even point, which is TR line, how to calculate profit, right? So all these things we should be aware of. If you understand these three slides, you will be able to 100% score at least 1 mark out of break even, which is very much likely. Break even chart, break even topic is very important. At least 1 mark question is must out of it. So please go through these three slides and you will be able to score at least 1 mark. So if we this is again say last example which we had discussed. Same data has been put in a graphical format. So here, if you remember, total receipt line, this blue line is total receipt line, right? And total cost line is this red line. So, and this x-axis is nothing but quantity sold or quantity produced, number of units produced, 0, 1000, 2000, 3000, 4000, 5000, and this is the total revenue, total cost. Total cost incurred by the total cost is nothing but equal to fixed cost plus variable cost, and total revenue is 7 rupees per unit multiplied by units produced or units sold in the market, right? So let us first see the cost side of the unit. So at 0, variable cost was 0, right? Only fixed cost was there, 10,000 rupees. That is why this point has been marked. So at 0 quantity there will be only fixed cost of 10,000 rupees, right? So that is what this line is called, fixed cost line. This is C. So if you have been given this type of two lines, 1 and 2, and examiner asks you fixed cost of this factory, then you have to simply check which is the TC line, total cost line. So lower point of the total cost line is nothing but fixed cost. So this part is, this amount is fixed cost, right? And this will be the total maximum loss at 0 quantity also. So fixed cost is the maximum loss which the company can incur if it starts producing 0 quantity. That is another question which examiner may ask. At 1000 units, the cost was 10,000 rupees of fixed cost plus other 2000 rupees of variable cost. So it was 12,000, right? At 2000 units production, cost was 10,000 of fixed cost till this point and 4,000 rupees of variable cost. So 14,000 was the point. At 3000 units, 10,000 was the fixed cost and 6,000 was the total cost, variable cost. So total cost was 16,000 rupees. At 4,000 points, 4,000 units production level, 10,000 was the fixed cost and 8,000 was the variable cost. Total cost of production for 4,000 unit was 18,000 rupees. It is where this point has come, 18,000 this. And at 5,000 units production level, 10,000 was the fixed cost and 10,000 was the variable cost, this part, right? So this is the total amount of variable cost. So here you can also calculate total variable cost at any production level. You can calculate level of fixed cost and TVC, total variable cost. So this is the total cost line. This is part 1, right? Likewise, there will be total revenue line also. This is TR line, blue line. Orange line is total cost line and blue line is total revenue line, right? So for total revenue at 0 production there was nil revenue. That is why first point is this. At 1000 units there was revenue of 7,000 rupees, if you remember in the previous table. For 2000 units total revenue was 14,000. For 3000 units total revenue was 21,000. 7 in multiplied by 3000. For 4000 units total revenue was 28,000. This is the total revenue. And for 5000 units production, total revenue was 35,000. 5,000 multiplied by 7 rupees per unit. So this is the total revenue line. So break even is nothing but the point where total cost line and total revenue line intersect. So this is the break even point, because here total revenue, this blue line, and total cost both are equal. So this is the break even point. So 2000 is the break even quantity and 14,000 is break even revenue. So without doing calculation, if this graph is given in the exam or question, you can simply by looking at the graph calculate the data, uh, find out the answer: loss, fixed cost, total variable cost, right? And then break even point, break even quantity, break even revenue. Now next examiner may ask you about profit or loss. Say if company is able to produce, say say for example, the company wants to company is producing 5,000 units. So that means the profit is profit is equal to area of y triangle. So this shaded area is nothing but profit. Simply calculate area of this triangle, right? And for loss, calculate area of this triangle. This is loss. So you can, if you know geometry, you can simply calculate area of this full triangle, this one, and you can deduct area of lower triangle, right? So likewise you can calculate. And there is another concept of margin of safety also. So in case the factory is producing 4,000 units, then margin of safety will be this dotted area. This is the margin of safety, area of dotted area, that you have trapezium. So this area you have to calculate. So we'll understand margin of safety in the next slide. So with the help of this single graphical picture, you can calculate all data. So let us understand margin of safety. Margin of safety is nothing but actual units sold minus break even quantity. Right. So it is the amount by which sales can drop before a loss will incurred by the entity. Now let us see what are the limitations of BE analysis, break even analysis. It assumes that the cost can be either fixed or variable. However, some costs may be semi-fixed in nature or cannot be classified as either of two buckets. It also assumes that all goods produced are sold, thus there is no inventory. That is practically not possible in all the cases. It also assumes that only one product or constant sale mix is happening. There could be multiple products as well. It also assumes constant sale price. Price remain constant, selling price. That hardly happen in the real time scenario. And it also assumes efficiency remain unchanged. So total capacity of the factory remain unchanged. That is keep on changing. Then break-even analysis further also assumes that the volume is the only factor affecting the cost. So these are the major limitations of the B analysis. But then the next question arises: why B analysis is required? Because it helps business entity to understand that the contribution from each unit sold above BE quantity adds to the profit, whether forecasted sale will be enough to produce the desired profits, whether further investment in the product is worthwhile. So these are the three main reasons why B analysis is required. So these are the few key points which are very important from examination perspective. Please remember these key terms, right? So if examiner is talking about any statement which states that these stay the same regardless of change in output, that means examiner is talking about fixed cost. If something is written that these change as output change, that is nothing but variable cost. Selling price minus variable cost per unit is nothing but contribution. This occurs when total sales equal total cost, that is BE point. A visual display of BE point is BE chart. Difference between actual level of output and BE quantity, break even quantity, is margin of safety. So these are the key terms and these are the hint statements from exam perspective. So before I am going to tell you about what we are going to have in our next session, I would like to request you to please subscribe to this channel and click on bell icon so that you will be notified immediately I upload the next session. So in next session we are going to cover microeconomics. We'll try to cover this microeconomics into 2 sessions. So this is the full syllabus which carries 3 marks as per IBBI exam. So consumption, price mechanism, pricing of product, factors affecting production and their pricing, theory of rent, capital and interest, and organization of profit. So we'll try to cover key bullet points, and 3 marks are easy to score after going to next 2 sessions. Thank you.